Let's start by taking you on a journey back in time. Picture yourself in ancient Mesopotamia about 3,000 years ago, a region largely corresponding today to Iraq and Syria. You are a laborer who just spent a long day building a great wall for King Adam. At the end of the day, before you go home, you need first to get paid for your work. So you are handed a tablet made of clay detailing your payment. No gold or silver coins, just a tablet made of clay. Well, this piece of clay is in fact one of the earliest known forms of currency in human history. Now let's jump to our modern times. You pull out your phone and pay for your coffee with a mobile payment app, or you exit a parking lot and the payment is made automatically. You can also send money to someone in a different part of the world almost instantly. In a split of a second, the transaction is completed. No coins, no bills, just a tap and a screen. So how did we get from clay tablets to these new forms of digital payments? How has money evolved over time? Together in this first episode, we'll explore the history of money and learn how it evolved and shaped our world today. I am Hamid Nash and welcome to e-Kompass. Before the existence of money, people operated on a barter system where goods were exchanged directly for other goods. For example, salt for vegetables or wheat for cattle. However, this system had its limits, such as the need to find someone who had exactly what you want and who wanted what you had, a problem commonly referred to as the double coincidence of wants. In a barter system, it was difficult to determine a fair exchange value between different goods. Imagine trying to figure out how many chickens are worth a sack of wheat or how many eggs are worth a cow. Not exactly an easy task. So how was this problem solved? Well, money was invented. The first form of money consisted of primitive items like shells. Shells, which were commonly used in ancient African civilizations, served not only as a medium for exchange, but also as a form of value storage. Stones were also used as a form of money. Take the Yap stones, for example. These are large circular stones used as money in the Yap archipelago in Micronesia. These stones could change ownership without being physically moved, obviously because of their size. Salt was also valued in many ancient civilizations and used as a form of currency in various parts of the world. In Ethiopia, salt blocks known as amales served as a standard medium for exchange for centuries. Similarly, in Tibet, salt was used as currency in trade, especially in remote areas where it was traded for commodities like tea, spices, and horses. Using shells and stones as a means of payment or value exchange was primitive, but it paved the way for more advanced money systems like metal coins made of gold, silver, and copper. These metals were widely accepted, durable, portable, divisible, and limited in quantity. The first coins were minted around 600 BC in Lydia, a region in present-day Turkey. These coins were made of an alloy of gold and silver called electrum and were stamped with a lion, the symbol of the Lydian king, probably the first brand logo in the history of money. Now let's move to the 11th century in China, during the Song dynasty, where the first paper bills called jiaozi emerged. Why this innovation? Well, because carrying gold and silver everywhere was impractical and posed issues in terms of the divisibility. For example, if someone needed to buy goods worth less than one gold coin, it was often problematic to split the coin without specialized tools, and there was always the risk of disagreement over the value of the fragmented coin. So the newly created bills served as substitute money, meaning they could be exchanged for a specific amount of precious metals. Their ease of use led to their widespread adoption, and it is this very idea of paper money that gave birth to the concept of fiat money. Fiat money comes from the Latin word fiducia, which means trust or faith. Fiat money is currency that has value only because we trust in it. Paper money, for example, has no intrinsic value. It is worth something only because we have all agreed to believe in its value. Otherwise, it's just a piece of paper. It's important to note that the shift towards fiat money was not without risks, as illustrated by the hyperinflation crisis during the Song dynasty. Over time, the system showed signs of weakness, especially during the wars against Mongol invasions, where increased military spending led the government to issue more currency without adequate reserves. This caused hyperinflation and a loss of confidence in paper money, severely disrupting trade and creating social division. The Chinese government later reinstated the exchange of paper money for precious metals to rebuild public trust and stabilize a damaged economy. So, although paper money did not completely disappear, the following Chinese dynasties, such as the Ming, were more cautious in issuing it. They implemented stricter regulations to ensure that the currency was adequately backed by metal reserves. Despite these challenges, paper money remained revolutionary in China for centuries. During this time of monetary innovation, Marco Polo, a merchant from Venice, visited China in the late 1200s. He was amazed to see people using paper money instead of coins, and each bill had a specialized seal to deter anyone from making fake copies. When Marco Polo went back to Europe, he told everyone about this paper money, and even though Europeans were slow to catch on, his stories started changing the way they thought about money. Today, most countries use fiat money. Fiat money is managed by central banks to keep it stable and trustworthy. Interestingly, this fiat money system has helped create modern banking services like ATMs or automated teller machines. Early versions of the ATM relied heavily on human intervention and had limited functionality such as cash dispensing. But over time, they got smarter. They became able to handle many banking tasks on their own, such as deposits, fund transfers, and bill payments. The technology behind ATMs include advanced mechanisms for cash dispensing and fraud prevention, networks connectivity that ensure real-time transaction processing, and secure protocols to protect user data. ATMs revolutionize banking by providing 24/7 access to cash and services instead of just bank hours. Their evolution made fiat money even more convenient for daily transactions. With advances in technology, online banking became a reality. People can do secure money transactions and access banking services right from their computers and devices. With smartphones so common, banks and financial companies started offering mobile services like paying bills instantly, checking account balance in real time, and transferring money worldwide. Today, technologies that make payment faster and easier are increasingly important. Point-of-sale systems and online payment gateways allow consumers to pay efficiently and securely. These systems let people pay electronically using credit or debit cards, digital wallets, and mobile payment apps. Electronic fund transfers, both within countries and internationally, have also revolutionized financial transactions. Systems like SWIFT or automated clearing houses standardize and secure the movement of money between banks, showcasing how technology enables financial connectivity and integration on a global scale. The following chapter in the history of money is cryptocurrency. Bitcoin was the first and is the most famous cryptocurrency. Cryptos used blockchain technology, which provides a decentralized and secure way to handle transactions without a central authority. This technology has sparked significant interest and innovation in the financial world. Today, there are over 4,000 different cryptos. However, the world of cryptocurrencies is like a rodeo. Prices can be extremely volatile, with significant ups and downs that can make it a risky investment. Regulatory uncertainties and security concerns also add to the complexity. It takes a careful consideration and resilience to navigate this dynamic and rapidly evolving market. Well, it's worth keeping in mind that despite the advances in modern payment and money transfer systems, alternative methods like the Hawala system still exist. Originating in South Asia and the Middle East, Hawala is an informal value transfer system where money is transferred between parties without any physical movement of funds. Instead, a network of brokers or hawaladars manages the transaction based on trust and simple ledgers. For example, if someone in New York wants to send money to a relative in Mumbai, they would give the amount to a local hawaladar in New York, and this broker then contacts the hawaladar in Mumbai, who delivers the equivalent sum to the recipient. The two brokers settle their accounts at a later date through reciprocal transaction or other means. The financial technology sector, or fintech, has also seen a surge in innovation that reflects a shift towards more inclusive financial services powered by technology. These advancements include peer-to-peer lending platforms, which allowed individuals to lend and borrow money without going through traditional financial institutions. Robot advisors also provide automated investment management services, often with low fees and minimum investment requirements. As we look to the future, the trajectory of money continues to be dynamic and promising. The evolution of currency from ancient clay tablets to digital transactions reflects our ongoing quest for more efficient and convenient ways to exchange value. With the advent of blockchain technology, cryptocurrencies, and innovative fintech solutions, the financial landscape is set to transform even further. We will see more of decentralized finance, or DeFi. DeFi applications use blockchain technology to enable financial services without intermediaries like banks. These innovations highlight the role of technology in creating more accessible and democratized financial systems. Embedded finance also represents the next frontier in this evolution. Embedded finance is revolutionizing how non-financial companies integrate financial services into their offerings. A great example of this is a popular ride-sharing app that now offers multiple financial features. This app allows riders to pay for their trips seamlessly within the platform. Drivers receive their earnings instantly after each ride and improving their cash flow. The app also goes beyond simple payment as it offers short-term loans to drivers for vehicle maintenance or upgrades. Riders can also purchase a trip insurance with a single tap. You get the point. The idea is to integrate finance into services that are not inherently financial. So instead of jumping between different apps to do various money tasks, you can do it all in one place. Central bank digital currencies, or CBDCs, are also emerging as a potential game changer. These are digital forms of a country's official currency issued and regulated by the National Central Bank. CBDCs promise increased efficiency and financial inclusion, but they also raise significant concerns. Privacy advocates worry that CBDCs would become a tool for unprecedented financial surveillance, allowing government to track every transaction in real time. What's more, CBDCs, if widely used, could pave the way to programmable money. Programmable money refers to digital currency that can be programmed to perform certain functions or transactions automatically based on predefined conditions. For example, programmable money would allow government to set expiration dates on a particular payment or restrict purchases of certain goods, or program money that is only valid with approved vendors or for specified items. We are not there yet, but the development of CBDCs and advances in blockchain technology can bring us closer to this reality. But like any big change, this brings both opportunities and challenges. We'll need to be careful about keeping our data private, our money safe, and making sure everyone knows how to use these tools properly. As we watch money evolve in exciting ways, it's important to remember its fundamental purpose. No matter how high-tech it gets, money is still about helping people trade and live better lives. So, as we move forward, we should aim to make money systems that work well for everyone. So, to stay updated on future talks about emerging digital technologies, please consider subscribing to the channel. Drop in the comments below your thoughts and what subjects you would love to see covered. See you in the next episode of e-Kompass.